Hey friends, so now Assalamu alaikum, welcome back. Now before we discuss the residual topics, let's have some exercises. So this is exercise 8.1, which says that on January 6, Malta Limited sells merchandise on account to Halle Incorporated for £9,200, term 1 by 10 and by 30, and on January 16 it pays the amount due. So this is quite straightforward. We have done this kind of entries in chapter 5 as well, so I am leaving it for now. E8.2. Presented below are selected transactions of Federer Apparel, and it sells in large quantities to other companies and also sells its product to small retail outlets. So five transactions. The first one, sold merchandise on account for this much. For these terms we can do it. Chapter 5, the company returned. Chapter 5, the company collected the amount. Again we have to take care of the discount, and also we have to consider whether this is a periodic system or a perpetual system. So when you see, for example, this entry, sold merchandise on account this terms this, the cost is not given. Now this means that it is all implied that this is the periodic system. So now you have to make all the entries um, keeping in consideration the periodic system. So the company sold merchandise to retail. The customer used his credit card. So how the credit card actually uh, the company credit card, right? So we actually discussed the entries probably in video number 1 or video number 2. See that video or see the chapter. That the company, if the company choose its own credit card, it's actually receivable, right? It's simply receivable. So you can see that entry in the chapter or in the video, and then do the entry. 15% monthly interest to customers credit balance, 1.5%. So the customer didn't pay after a month, so by 31st month end, so charged 1 month interest. So by the amount of interest, we again debit account received from the particular customer, and we credit the interest income now. So this has been discussed again in video number 1 or 2, I don't exactly recall, or you can read the chapter as well. Generate this. The company sells merchandise on account to this terms this on January 16, pays the amount on. So this entry is also, as we can see, this generalized entries for recognizing account receivable. So it's already done generalized receivable transactions. So this is also, I think, straightforward. And okay, so it has some allowance entries. So let's see. At the beginning of the current period, the company had balances in account receivable of 200,000 and an allowance for doubtful accounts of 9,000 credit, right? So the net cash realizable value of account receivable that should have been shown in the immediate preceding balance sheet would have been 191,000. Okay, so during the period it had net credit sales of 800,000 and collection of 763,000. So it wrote off an uncollected amounts receivable of $7,200. However, a 3,100 account previously written off as an uncollectible was recovered before the end of the current period. Uncollectible amount accounts are estimated to total this at the end of the period. So this amount, which we discussed in the immediately preceding video, actually this amount is something which we can estimate by percentage of receivable method or aging, but they have given this amount in this particular exercise. So now let's see entries one by one. Prepare the entries to record sales and collection. So for the sales, right, so this is the entry. It has a net credit sales, so account receivable debit sales credit. For collections, cash debit account receivable credit, right? So this is the first one. Prepare the entry to record the write-off of uncollectible accounts during the year. So since the allowance account is already there, right, allowance, it means they are actually using the allowance method, and in the absence of any information you have to assume that they are using the allowance method. So under the allowance method, if we write off any account, if it means a customer is confirmed not to pay, we do not debit that expense. So just see those two videos, immediately preceding two videos again, or maybe three videos. We debit the allowance account and we credit the account receivable account. So that amount which we have put in allowance account as an intermediary parking account. So now we confirm that this customer is not paying, so we reduce the allowance and reduce the receivable. So the entry will be allowance for doubtful accounts or allowance for doubtful accounts. Yes, this is the title. So we have to keep the title same, debit and account receivable credit. However, a $3,100 account previously written off uncollected was recovered before the end of the current period. So this is recovery. So refer to the recovery video. When it is recovered, so we just reverse this entry first. So this entry, this kind of entry which we would have been made for this amount as well in the previous period, we reverse it. So we first of all we debit account receivable, we restate account receivable, and we credit allowance account, right? Because this is the entry we would have been made when we have written off the account receivable. So number one, and number two, of course, we have received cash, so cash debit and account receivable credit. So these two entries for this one, right? If you are not clear, again read the chapter or see those two videos or three videos again. And uncollectible accounts are estimated to total 25,000 at the end of the period. So 25,000 is going to be my uncollectible account receivable, right? So now I have to do some working. I cannot record entries simply by this amount, right? Because this is the uncollectible accounts are estimated, right? So out of the total account receivable, this much has to be uncollected. It means the allowance for bad debts or allowance for doubtful accounts balance after the adjusting entry should be this one on the credit side, right? So let's work out the balance of account receivable, although it is not required over here, but this is the entry, but maybe we will need it for the balance sheet, right? Ending the ending account receivable. So let's first work out this part. So 200,000 plus debit of 800,000. So this becomes 1 million minus 763,000. This becomes 237,000. 237,000 minus 7,300 gross account receivable. So it becomes 229,700. If I make a mistake, so just verify from calculator. 229,700 plus 3,100, so 232,800. So this is the balance of my total account receivable, 232,800, right? Now let's work out the balance of the allowance for doubtful accounts before the adjusting entry, right? So it was 9,000 credit, then there is no effect of this transaction, no effect for this transaction. Then for this transaction we actually debited the account receivable, right? Debited the bad debt account and credit the doubtful allowance for doubtful accounts and credit the account receivable. So it has a debit on this, so 9,000 minus 7,300, so the remaining balance is on the credit side 1,700 plus 3,100. By this amount we again have credited allowance account, debit account receivable, credit allowance. So 1,700 plus 3,100 becomes 4,800. So this is the total balance in my allowance account as of now. Whereas what I need in this account, 25,000. So 25,000 minus 4,800, it is actually 20,200. So do verify these calculations on calculator. Maybe if I'm not doing any mistake, I'm doing these calculations mentally. So 20,200 as per my calculations is the amount required for this entry. So prepare the entry to record bad debt expense for the period. So bad debt expense for the period is 25,000 bad debt expense and 20,200 bad debt expense and 20,200 allowance for doubtful accounts. Now keep in mind, if you recall the very first video, we we recorded straight away this amount in the bad debt expense. Why? Because there was no allowance account in that video. There was no allowance balance. So if there is allowance balance is zero, then of course this is the amount we have to record for the entries. What is the net realizable value of the account receivable? So we worked out the total gross value over here and the net allowance for bad debt account after the existing entry. So the net will be whatever the account receivable minus is 25,000. Right. So now let's do one more exercise for determining the amount. Okay. So now this says that my account receivable are 110,000 towards the end of the period. My sales revenue is this and my sales returns are this. If the company uses the direct write-off method to account for uncollectible accounts, generalize the adjusting entry at December 31, assuming Calder determines that 1400 balance is uncollectible, right? So although keep in mind that this question is wrongly phrased, adjusting entries are usually not made under the direct write-off method. They are the journal entries, but they have phrased it adjusting entries. It means that rather than making an entry at the time the customer is defaulting, they at the end of the period they review all the customers and they come up that okay, this is the customer who is not going to pay, so we have to write it off under the direct write-off method. So recall the first video or the second video, the direct write-off method, simply bad debt expense debit, account receivable credit, no allowance account. If allowance for doubtful account has a credit balance of 2100 in the trial balance, generalize the adjusting entry at December 31, assuming bad debts are expected to be 10% of account receivable. Right. For this scenario, 10% of account receivable, it means bad debts will be the account receivable balance is actually 110,000. So 110,000 is the account receivable balance, and bad debts are 10%. So bad debts are supposed to be 11,000, right? If I'm not wrong. Yes, it is 11,000. So 11,000 are going to be has to be my balance in allowance for bad debts or allowance for doubtful debts. Whereas the existing credit balance is 2,100. So the entry I should pass is by 8,900 to make it 11,000. Again, verify the calculations. If the allowance for doubtful accounts has a debit balance of 200, and assuming the bad debts are expected to be 6% of account receivable, so we have to work out the 6% of 1,1000, 110,000. So 6% would comes out to be, I think, 6,600. So 6,600 has to be the balance in doubtful account allowance. The existing balance is 200 debit. So in order to make a 6,600 credit, we have to first reverse this 200 debit and then 6,600 credit. So the total amount of the entry would become 6,800. So bad debt expense 6,800, allowance for doubtful accounts or allowance for bad debt 6,800. Again, do verify the calculations. Now this is the aging question, probably the last question for this video, and prepare the adjusting entry. Determine bad debt expense. Okay. The company has account receivable of 95,400. So this is 95,400, and they have given the breakup as well. So the current due amount in 1,000 credit terms are this. At March 31, there is a 2,100 credit balance and allowance for doubtful accounts. So there is already credit balance of 2,100, right? The company uses the percentage of receivable basis for the estimating. So now we have to estimate, right? So 2% of uh, okay, okay. So why there are two columns? So first we have to make sense of it. So amount in 1,000 credit terms are this at March 31, 2020. So we are over here. Okay, the amount company uses the percentage receivable basis for estimating uncollectible. The company estimates the bad debts as follows, right? Determine the total expected uncollectible at March 31, 2020. So it has to be, so we don't need to use this column for now for requirement number one at least. 65,000 multiplied by 2% plus 12,900 multiplied by 5% plus 10,100 multiplied by 30% plus 7,400 multiplied by 50%, right? So this will give us the uh, total estimated uncollectible at March 31. This has to be the balance in the allowance account. Prepare the adjusting entry. So the adjusting entry will not be made by this amount, rather it will be made by this amount minus already credit balance there is, right? So we have to deduct this amount and then make a credit entry so that the total will become equal. The total of the allowance account after the adjusting entry would become equal to the total of these percentages. Discuss the implication of the changes in aging schedule from 2019 to 2021. So this is only there given to discuss the implications, right? So for example, the current dues have reduced, the 1 to 30 days dues have increased, the 31 to 90 days dues have increased, and over 90 days dues have increased. So how do we evaluate the performance of our collection department? So collection department was performing well last year because the overdue accounts were only rare, whereas this time they are much higher. Or how do we evaluate the credit policy? The credit policy was well managed, right, last year as compared to this year. So this is just a verbal implication narrative which you might have to show. So probably I don't guess that these kind of questions will be examined. So that's it, and there are questions on recovery as well. So I think we have already done a couple of questions on this. So in the next video we shall cover some remaining topics on this area. Thank you.